Tell me, I am an investor that needs income. Where can I look for higher income levels?
Okay, thanks, Marianne. Generally, investors look for income. They look to fixed income products. So they look for bonds, repurchase agreements, or similar fixed income products. We've seen over the past few years that the interest rates on these products have been coming down and have been pretty low and don't seem to be rebounding anytime soon.
Tell me about it.
So for the investor who has a little higher risk appetite, willing to take a little more risk, then one avenue they could look at exploring is called a structured note. So what a structured note really is, it's a debt instrument issued by a financial institution, and the performance of it is linked to certain criteria being met. So the criteria is going to be linked to either the price performance of a single stock, the performance of a basket of stocks, changes in interest rates, or changes in commodity prices. So I'll give you a quick example. So let's say Sterling offered a structured note at promising to pay you at 9%, but it is linked to a basket of stocks including Apple, Exxon, and Walmart. If the price of any of those stocks should fall below 50% of the current value, then you would not receive that 9%. But once they all remain above that 50% value, then you will get your 9% interest.
Wow, Dwayne, that's a lot to handle. Okay, so let's go back to basics. You just mentioned an example, which is great. Thank you for that. Now, what happens if the price of that stock, one of the stocks in that portfolio, say Apple, falls by, say, 56% before the maturity date, but the prices of Walmart and Exxon go up in price? What happens to my interest payments, that nice juicy 9% coupon?
Well, once any of the stocks, either one or more of those stocks, fall outside of that 50% band, then you would not receive that 9% promised payment.
Okay. And now what happens if it declines by 55%, but then it goes up by another, say, 40%? Before the end of the note, before the maturity date, what happens then?
Okay, so for the period that it is below the 50% mark, there would not be any interest payments paid if those are due during the period. Once the price is rebound and you get back within that 50% limit, then the issuer will now resume making payments. There, however, that's a sort of shady area. You have two types of structured notes when it comes to that. If it has what's called a memory feature, then the missed interest payments will be paid, and then you'll resume payments going forward. If it doesn't have a memory feature, then those will be foregone.
Okay, I only want to look at structured notes with memory, Dwayne. Now, tell me something. What happens if the equity price of, say, one of the stocks is below 50% at maturity, at the maturity date of the structured note?
Okay, so if at maturity one or more of the stocks are below 50%, your principal is now affected by the worst performing stock in the portfolio. So let's say Apple were to fall by 55%, then you would be foregoing 55% of your principal and you would be repaid 45%. So that is really the risk associated. So it is very important, especially when looking at structured notes, to speak to your advisor and have an understanding of the underlying assets, how they perform, how they can be affected by current market conditions, future market conditions, so that you can know and understand the level of risk that you're undertaking.
Certainly. And I imagine it would be beneficial to us to buy those structured notes when the prices are kind of near their all-time lows,
Right,
for example.
which we've seen happen very recently.
Right.
And that is why I say if your advisor can guide you to tell you, what the price is during a normal market, what the price fluctuation is during a volatile market, then you can have a better understanding of when is a good entry point and, the possibility of that 50% dip. So,
Excellent. Thanks. Eugene, do you have anything to add to that?
Yes, Mara, thanks. Well, just to add that the coupon on equity structures, based on what we have seen recently, those coupons can range anywhere from 6% to even over 20%,
Wow.
depending on the underlying stocks themselves and the level of downside risk that you're willing to take, or the amount of downside you're also willing to give up. So for instance, if you're, rather than say, taking a 50% protection level, you opt for something more aggressive, say 20, 30%, you can improve your coupon that way. But of course, the risk of the note not performing is even greater then. So just remember that the risk-reward dynamic. The greater the risk, the higher the expected return, and the lower the risk, the lower the reward. Also, like bonds, structured notes can be called, especially if the underlying stocks perform well. The issuer has the right to call those structured notes. Additionally, there's also a feature on many structured notes called auto call feature, which basically allows an automatic call of the structured notes once all the stocks, which pretty much embed the structured notes, once the prices of all of those stocks are greater than the prices at the time the structured note was issued, then the note will automatically get called. So just bear that in mind. So even though a structured note maybe 3 years, with an auto call feature, it could even get called as soon as the next interest payment date, depending on how well the underlying instruments perform. And then finally, structured notes are not for every investor. I mean, they're highly complex and customizable structures. As a result of that, there is no or a limited secondary market for structured notes. And so structured notes are really geared for the buy and hold investor. And the minimum investment amounts on structured notes are usually between $50,000 to $100,000 US.